Good morning, everybody. April 6th. I'm Garrett Baldwin. Welcome to the Morning Burr. Burr? Sure, that'll do. Hope everybody's doing well. We are pre-market and we are fantastic. It was a great weekend, 3-day weekend opportunity for everybody to relax, recharge, get ready for another hectic week for these markets. But on Thursday, we did see a little bit of improvement in our capital wave score. And this morning, significant improvement, largely as the number of stocks that we're breaking down continue to move out of that breakdown category, kind of finding a near-term bottom in recent days. That said, we're keeping an eye on names like Visa and MasterCard and the regional banks, which are waking up a little bit finally, but there still is that persistent weakness in the insurance industry and concerns about private credit, which we'll talk about as Jamie Dimon mentioning some of these concerns in his annual letter to shareholders. The news is obviously that Pakistan is potentially brokering a ceasefire deal between Iran and the United States. That could kick in as soon as tomorrow. Otherwise, if you got President Trump's Easter message, you tried to flush yourself down a toilet yesterday. Yes, you did. Yes, you did. All right, let's get into it because we got a lot riding on the next 24 hours. We'll be talking about WTI, Jamie Dimon, the ceasefire, and the CPI number. That CPI number coming out this week. And boy, even if we get some good news and a gap up on the story about Iran, that CPI number Friday is very, very significant. So let's look at the numbers. This morning, S&P 500, 66.28, barely green, up 0.06%. The Dow is actually red, down about 70 points. The NASDAQ up a little bit, and they were down roughly 0.7% on Sunday night, but flipped on the ceasefire news, now fading. On the commodity side, WTI had gapped up overnight to about 115 and pulled back to 109, all because of one phone call. Brent at 107, gold at 47.21, up almost 1%. And the key thing that I do want to note as we look at this right now, you want to pay very close attention to the dollar index. So every morning we head over, we take a look at what is going on with FinViz, and we see that the dollar index has pulled back from the 100 level. Remember, that 100 level is that key line in the sand. And if these markets do start to sell off and we continue to see any crisis or ongoing pressures in the financial system, there is a race to the dollar. One of the primary issues that we have discussed is the fact that at this time, nations had been selling gold. They have to raise dollars for the purposes of purchasing oil, but that creates new pressures across the financial system as well, things that we've discussed for the better part of, 6 months. All right, well, let's continue with the good old fun. That VIX level still around 25. Bitcoin popping up to about 70,000. That's just telling us a little bit about the current state of affairs in the financial plumbing and, a little bit of abatement, a little bit of improvement, but it's not huge. We're almost kind of right back where we started a week ago. Not a ton of, massive market reaction. But the problem is, this, right? A 45-day ceasefire is on the table. Pakistan's army chief brokered the call between J.D. Vance and Wickoff and Iranian leadership. And this is the thing. This includes the Hormuz reopening. It must be agreed upon on Monday. If not, if you did not see President Trump's warning on Easter, hell is it's a hell is coming type of moment. It's very comparable to something that we saw during COVID on a statement by a very certain hedge fund manager. But that said, President Trump will speak 1 p.m. at the White House. The overnight news: Israel struck four different areas across Iran. Iran hit 186 locations in Israel. Iran struck a U.S. camp in Kuwait in Bubian Island. That's a fun word to say. Missile drone warnings across the UAE and Dubai. This was a big one. The IAEA saying that Iranian uranium, that's a hard one to say, is nearing weapons grade and that they have a sizable uranium stockpile that could be used in several warheads. The IRGC has hit Israeli ships at Jebel Ali port, and Serbia located massive amounts of explosives next to a key gas pipeline, once again drawing our attention north in the region of what's happening between Ukraine and Russia as well. WTI crude jumping and then pulling back. And this is kind of the knee-jerk reactions that we're seeing in this market right now. And a reminder that this is not what markets have been designed to do. We are not supposed to be trading on the Twitter account of one individual. But the thing that I do want to note and the thing that I do want to point out is what we wrote about 2 Sundays ago, which is to watch the OILU. That's the microsectors oil and gas exploration and production 3x leveraged ETNs. Ooh, that's not a fun thing to say. But as we have noted, that is a crucial line in the sand on that 20-day moving average because it helps us get a better sense of where large institutions, CTAs, hedge funds, anyone who is at the institutional level, if they are dumping, it has been showing up on this chart. And I remind you, we go back to the war that was happening between Ukraine and Russia, still happening, back in 2022. We saw a huge move higher on the UTN into June, and then a massive sell-off among CTAs and funds. And one of the key things, again, there were concerns about higher interest rates and concerns about inflation, but the risk-off event that transpired there was part of the largest hedge fund sell-off in 15 years, and it led to a manic move down in the S&P 500. We've seen a couple of interesting observations. We've talked about the oil markets over the last couple of days. We're seeing some analysts come out and suggest that oil could drop significantly if there is an end to this Iranian conflict, and then we start to have deeper conversations about recessionary pressures and, of course, the impact on the consumer. There has obviously been concerns as well about deflationary pressures happening around the globe, and these are things that we're going to continue to discuss, and I'll mention a few key points around what is transpiring with South Korea in just a moment. But let's keep this party going, everybody. If the ceasefire holds, we can see oil fall under 100 pretty quickly. If it falls apart, Brent can gap right back up. And this is a market trying to make sense of just one headline. It is very complex. That said, OPEC did meet over the weekend. That was very important. They all kind of on paper saying that they're going to increase their production to 206,000. But because most of these Gulf states are stuck on the backside of the Strait of Hormuz, the expectation is they're probably not going to meet that capacity. Abu Dhabi's petrochemical is still going to be offline. They're saying it's going to take at least a year to engage in repairs. We've seen power plants hit in Kuwait. And there was a key development that did transpire over the weekend, and that is Iraq has been considered a quote-unquote friendly nation by Iran, which would allow some of their ships to move through. The Ocean Thunder, which carries about 1 million barrels, did pass through the Strait of Hormuz, the ship, and an Iraqi exemption could unlock about 3 million barrels per day internationally, helping to alleviate some of the pressure from what has been lost already. The headline number on the jobs report on Friday, I did a big rundown on this on Saturday. It does not change my opinion about anything. 178,000 jobs were created versus 60,000 expected. The previous month was minus 92,000. It was revised up, and it was a pretty significant revision upward. That said, unemployment is at 4.3% versus an expected 4.5%. The key thing I do want to note about this is that number stayed in place largely because so many people left the actual employment base that our employment participation rate declined to 61.9%. It's not because more people found work. It's because there's fewer people inside the system to actually measure. And the headline and the reality are moving in completely opposite directions. The market hasn't traded this news yet. We're going to see how it impacts overall sentiment moving forward. This is a significant amount of people in the United States who are working age and not working, not part of the system, And remember, we have about 2 million more coming out of college in the next couple of weeks. If they don't find work after a month, guess what happens? They just fall out of the system as well, and they don't count toward that 4.3% as well. 488,000 people left the job force in labor force in a month, and that is a just staggering figure and a sign of the times, because so many people saying they cannot find work that suits them. If we dig under the hood just a little bit more, the report itself was, overly rosy headline. Healthcare was about 76,000 of those jobs, of the 176,000 total, but about 35,000 of those jobs were physicians returning from a strike. So these are not new jobs, and that's an important thing to note. People are just going back to work, and we count them as employed or new employed. If you strip out that strike, if you cut the down to the real underlying growth, it's about 143,000. We saw a diffusion index. That's the number of industries that are cutting versus adding. It fell under 50 in February. That means more sectors are cutting American workers than adding. And why does all of this matter? Well, the marginally attached workers, that increase. These are people who aren't able to find the full-time work that they want. Discouraged workers absolutely surging to 510,000. These are people who are saying there isn't a job out there for me. People who are now part-time employed for economic reasons, increasing by about 270,000. That is employers pulling back without issuing the layoff notices. One of the important things to note about that, think about a Best Buy cutting hours. They still have to remain open at the locations. But if they're cutting hours of different people who are part of the marginal staff, that's putting the stress on the people who are there the most, the full-time employees, the people who are assistant managers and managers, which may explain why some people might be a little stressed and moody in the retail space. Long-term unemployed increased to 322,000, or increased by 322,000 over 12 months. And that means that 1 in 4 people who are unemployed in the United States have not worked in over 6 months. The longer that goes on, the more difficult it will be for them to find work. All right, on top of this, let's talk briefly about the letter that was written by Jamie Dimon. Jamie Dimon obviously is a very important man. Who would play Dimon in the next financial crisis? Who? That's a really good one. Well, it's not going to be Bill Pullman, right? Well, Bill Pullman was Jamie Dimon in Too Big to Fail. But Bill Pullman, I mean, how old is Bill Pullman now? They don't even have his age listed on the internets. Wow. Bill Pullman somehow got his Bill Pullman got his birth date pulled off of Wikipedia. Good job, Bill Pullman. All right. Well, total completely useless information on a Monday. All right. Jamie Dimon's letter, dropped his letter, and it reads like a warning shot across the bow. And remember, Dimon's pretty good at this. So the key warnings are geopolitical risk. He says this is the most dangerous environment since World War II. He says that these geopolitical risks are, quote unquote, not priced in. Hey, weird. It's almost like everybody in the efficient market hypothesis thinks that everything is priced in. Iran, Ukraine, China. No, right? So once again, remember, the Iranian war kind of acting as that last snowflake that creating the avalanche on top of all of the other existing problems. And those existing problems are what Dimon are discussing about inflation remaining stickier than expected. Oil, tariffs, deficits, all feeding on all this. There is less room for cuts than markets think. And if we are in the most dangerous environment since World War II, well, that kind of puts us in a 1940s environment. Ooh. Private credit also making the letter saying that shadow banking has exploded. It is under-tested. It is under-regulated. And it is a massive risk if credit tightens. And we discussed this, and this is kind of mentioned in his letter a little bit that, he focuses heavily on those warnings, basically saying that the most significant opportunity, significant technology revolution of his lifetime is AI. They're deploying it across JP Morgan. It will affect every job at the company. But to stress that issue around private credit, he talks about bank regulations, and he took direct aim at the Basel III endgame, calling everything punitive. He's saying that it is restricting lending and pushing risks into the shadows. And that's one of the key lessons of the Dodd-Frank Act. That is one of the key lessons of the post-2008 world. When they wrote new regulatory regulations, they started to punish the banks for doing what they were supposed to be doing. Now, I'm not talking about the biggest banks, JP Morgan, et cetera, but focus on some of the smaller, the regionals, the community banks. These are institutions that are holding reserves, and they've made it more difficult for them to lend. Now, on the other side of this, what you have seen is this continued shift where large financial institutions like Goldman Sachs no longer want to take the risk associated with operational lending in any capacity. So what is happening? They are effectively acting as loan origination for mid-market companies and then handing it off to private credit, where it is less regulated, far more opaque, and much more difficult to see. And this stuff is not on those banks' balance sheets. These things do matter significantly. So important to note, we're looking for some regulatory shifts. This lands right before the CPI week, with gasoline up about 35%, as he talked about and warned about inflation. A couple more quick things. I want to give a little bit of a shout out to Gray Rabbit Finance for pointing out something before I could this morning, and that is that South Korea needs to be the country that we want to focus a little bit on. Now, I'm not asking for everyone everywhere to be an expert on South Korea, but we've watched what has happened in Japan over the last year and a half, going back to the Nikkei crash in August of 2024. What is now happening in South Korea and why this matters, this is a significant wake-up call. It is not just what is happening with helium and semiconductors. That's all very important, but you have a combination of two things happening: physical impact on companies, but then credit and financial impact on companies. These two things will run together. Credit is tightening at the margins, and South Korea is one of the first canaries in the coal mine. Corporate bond issuance is expected to fall more than 30% this year, and Kospi is in the sharp correction. Spreads are widening, yields are widening, and we want to note that it's not always the United States that's going to be the big issue. We have to pay attention to what other nations are doing, particularly Western nations, ones that have trade relationships with the United States and ones that can be impacted dramatically by changes in capital and credit conditions in the global financial system. So there is heavy sensitivity in the South Korea to U.S. yield moves, and there is rising foreign ownership of local bonds and a very hawkish central bank. Large amounts of debt are maturing right now as capital is getting more expensive. This comes from Gray Rabbit, and this is how tightening actually happens. It's not just policy hikes, it's markets pulling away and assessing that risk. So we've seen problems in Japan in the last few years. We saw major credit issues hit the Bank of England back in 2022. This can go all the way back to 1994 with the tequila crisis in Mexico if we want, but we can also discuss some of the other challenges and the sensitivity to the transmission between the United States Federal Reserve and other foreign countries. And it's very important to note that if this tightens up, physical issues become a problem as well. And I want to remind you, we've talked about the impact of the helium supply and semiconductors too. Iran had hit Qatar's Ras Laffan LNG complex. 1/3 of the global helium supply comes from that spot. So Qatari helium exports are down 14%. 2/3 of Korea's helium imports come from Qatar. Samsung, SK Hynix, they're all at risk, according to the New York Times. And these regions are playing, with 6 weeks of reserves and 5 years to restore those reserves if we continue to see some pressure. So even though we have, the possibility of this Iranian ceasefire, this situation is still not improving. It's still there. It will lurk in the background, and it might not show up in the next couple of days. It might be pushed to the back of the Wall Street Journal. But these credit issues, they are starting to really expose themselves here in the United States, but also in foreign markets as well. And we have to pay attention to what is happening internationally, because those foreign challenges can quickly, those ripples that start in South Korea can quickly become tsunamis on our shore if we don't monitor them correctly. This week, the CPI will be in order on Friday. The Federal Reserve minutes come out on Wednesday. CPI is expected to increase by about 0.9% this week, 3.3% year over year. A lot of sticky focus once again on services. But the other thing that is important is the impact of gasoline. Gasoline surging 35% from late February to the end of March at a 2.8% CPI weight. Gas alone can add half of a point to this index. The ISM manufacturing prices paid hit 78.3. That is the highest number since 2022. That has significant marginal pressure across the entire economy. CPI swaps are already pricing April inflation in at 3.9%. 9%. The Fed, Citi just pushed one rate timeline to September, October, December. It was June, July, September. Robin Brooks saying that there is a Trump premium forming in bonds. The back end is starting to rise faster than that front end. We have the Warsh Fed nomination hearing set for April 16th. A little bit of fireworks already starting. Some people saying they will not vote for Warsh because they want an investigation into the Federal Reserve around whether or not Jerome Powell misled Congress, or in case of the use of the word is lied, about renovations. Are we really doing this? Okay, whatever. Just one more thing. The Fed, meanwhile, is frozen and can't cut into oil inflation and cannot hike into economic fragility. The calendar this week, pretty simple. ISM, the Trump presser today at 1. Power plant day, if no deal. That means Trump saying over the weekend, Happy Easter, that if we do not see the straight reopening and we do not see some movement toward peace, then they're going to start hitting the power plants and the bridges. Wednesday, we have the FOMC meetings. Delta will report earnings, as will Constellation. We have Thursday, we have the PCE, 2.8% year over year expectations. PCE core at about 3% on expectations. That seems not incorrect. Let's get rid of that. I thought that already happened. And then Friday's where the CPI number is. So, 4 out of 5 ain't bad. All right. What to watch? Ceasefire and escalation. 45-day deal must be agreed on today. Trump presser at 1 p.m. for signals. If it holds, oil at 100. If not, Brent clears 120. Jamie Dimon, the CPI setup, obviously this week. The bankers saying, right, that things are not priced in geopolitically and that inflation can persist. Right before the CPI this week with gasoline plus 35%, and Robin Brooks seeing a Trump risk premium for bonds. Of course, we want to see what the job reaction is, especially with that diffusion index dropping under 50 during February. But again, a strong print will give bulls confidence, or is something lurking underneath? We wrap with this. Once again, if you are not a member of Money Printer Pro, it's pretty damn easy. All you got to do is just sign up, get access to our moneyprinterpro.com platform, including our momentum reading, our breakout and breakdown stocks, and a full deep dive platform for you to assess the current state of affairs for every stock. The ceasefire trade is really the story today. We're going to see a pretty significant shift in sentiment, I would imagine, when Trump speaks today, hanging on every word. Dimon has provided the roadmap for the challenges for the rest of the year, and oil is currently sitting at 110. And once again, yesterday we released the Hedge of Tomorrow for members of Money Printer Pro, postcards from the edge of the world, and the insider buying report. If you want to sign up and get access to that report, please do so. I hope everybody has a great trading day. Any questions, put them in the comments. And of course, stay positive.